Hi, good morning, everyone. If you could grab your last cup of coffee and find your seats, we'll get started. So thank you all for joining us this morning to attend our regular Breakfast Knowledge and Networking forums. This week's theme is access to capital. It's something that is near and dear to the hearts of many in this room. It's also, I think, collectively one of the biggest challenges that we face as a sector. And that's why it's a very important topic and one that is much talked about. And we have assembled a group of great panelists this morning. I'll let Tracy do the introductions immediately after me. But I wanted to start off just by saying a quick thank you to Fasken Martineau, again, for hosting us this morning, and to Tracy for moderating the panel this morning. For those of you that don't know Tracy Hui is a partner in the Securities Mergers and Acquisitions Group here at Fasken's, and she's the co-chair of the Ontario Life Sciences practice. Fasken's is also a great partner of Life Sciences Ontario. They're a member of ours, but they are a great model as a member of Life Sciences Ontario. And what I mean by that is they don't just sign up and write a check to us once a year. They really have embedded themselves into our organization as volunteers, both by donating space such as this, but the time of their employees as well. And we have several members of Fasken's that volunteer their time as part of our committee. So, Tracy, I just want to extend our appreciation again to Fasken's for their continued support. So with that, I'm going to hand the mic over to Tracy to introduce the panel.
Good morning, everyone. I apologize in advance. I have a bit of a cold today, but I'm not going to be doing most of the speaking, so hopefully it'll be okay. So as Jason said, the need for capital continues to be a pressing issue for companies in the life sciences space. I practice in the securities and mergers and acquisitions area, so I regularly work with young companies seeking capital and trying to find solutions for their capital needs. We thought that this would be an important session for on the breakfast committee, and also we thought this would be an important session for all of you. We have a very impressive panel for you today. We have a range of experiences and perspectives. These people have all worked with life sciences companies in some way in their quest to access capital. So I'll just do a quick introduction before we get started. Just moving down the panel here. This is David Allen. David Allen, just to start, is actually a member of the board of Life Sciences Ontario. He's also a chairman of Avid Biologics, a private antibody drug conjugate company. And he's, prior to that, he was 3 years at Stem Cell Therapeutics Corp., where he was executive chairman from 2011 to March 2013. Prior to that, he was the founding chairman and CEO of YM Biosciences, and you've probably heard of that company. It was recently acquired by Gilead Sciences in February 2013. In 1992, David founded the first biotech-specific investment banking team in Canada. So he's got experience from that perspective as well. Not helpful with my cold. Creating a number of life sciences companies, including the novel Drug Royalty Corp., YM Biosciences, and others. As I said, David's a member of the Life Sciences Ontario Board, and in 2012, he received the Gold Leaf Award from Biotech Canada for industry leadership. So clearly, impressive thought leader on our panel today. Beside David is Natalie Bouchard from Royal Bank. She's an account manager there with the Life Sciences and Health Services team. She works with early to mature stage life sciences companies that have high growth potential, a strong R&D focus, and an international outlook. The Life Sciences team at Royal Bank was founded in 1985 and provides specialized full-service capabilities to over 200 companies in the GTA region alone. Natalie also comes to the table with a background in science. She has a Bachelor of Health Sciences at the Faculty of Medicine at the University of Calgary and a Master's of Health from the University of Ottawa. Next to Natalie is Ivan Weisbooth, who's currently the CEO of ScarX Therapeutics. So he'll be helping us to see the perspective from a small company. He has over 8 years of early stage drug development and commercialization experience. Before joining ScarX Therapeutics, Ivan worked as a commercialization manager at Mars Innovation, where he managed the development of multiple non-clinical therapeutic programs, ranging from drug discovery, formulation development, and non-clinical proof of concept studies. Prior to Mars, Ivan worked at the Center for Drug Research and Development, and worked as an intern analyst at the life sciences venture capital company Burrell & Co. Probably heard of them. Welcome, Ivan. Beside Ivan is Prakash Gaud. He's the managing director, healthcare investment banking at Euro Pacific Canada. He currently leads healthcare investment banking there. He brings over 20 years of extensive knowledge and experience in life science, capital markets, and the pharmaceutical industry. He's a highly respected investment analyst with an outstanding track record in Southside healthcare equity research. Previously, he leveraged valuable expertise and insights to help guide new product planning and development at GlaxoSmithKline and as a pharmaceutical consultant. Prakash recently served as managing director at a healthcare strategic advisory firm, as well as a director of a public drug development company. Welcome, Prakash. And at the far end of the table, we have Michael Kasey from the Toronto Stock Exchange and the TSX Venture Exchange. He is one of the heads of business development there, and in this capacity, he's responsible for working with private companies and their shareholders as they explore the option of raising equity capital in Canada. Mr. Kasey has been involved with several corporate strategic initiatives for the exchange. Prior to joining the exchange, Mr. Michael spent 16 years as an investment banker in the Toronto office of a leading international bank, where he advised corporate boards and management teams on a range of domestic and cross-border capital raisings, mergers and acquisitions, and corporate restructurings. So I'd like to welcome the panel. It's an impressive one, and hopefully we'll get some great insights from them today. We have a lot to discuss today, so we'll get started right away. It will range. We'll discuss a range of topics, starting with a fairly general overview of the trends in the marketplace. Then we'll focus a bit on some equity, debt, and indirect sources of capital that you may look to. Then we'll comment a little bit on go public transactions, kind of the CPC qualifying transaction, and the pros and cons of pursuing a go public transaction. We will definitely leave some time at the end for your questions. If you can save them up to then, that would be great. And with that, we'll get started. So as I said, we thought we should begin our discussion today with an overview of the current fundraising environment in Ontario for early stage life sciences companies. I'm going to ask each of the panelists to comment on the environment and the factors that they think are driving the current environment, whether that's the economy generally, government stimulus, corporate VC activity, or even improved understanding of the value proposition of life sciences companies. What's going on out there for investors? I'm going to start, though, with a bit of a more formal presentation from Michael. He's going to come to the podium and present some results from the Toronto Stock Exchange and TSX Venture Exchange. Brian's right up here.
Good morning, everyone. As Tracy said, I'm one of the heads of business development at the Exchange. I joined the group about a year ago after having spent nearly 20 years as an investment banker. So I've had the benefit over quite a long time of working with private companies, but also spending my life, honestly, talking about the capital markets and the evolution of different trends and patterns in the capital markets. And what we've seen over the last number of quarters, let's go 2 years, let's say, in the Canadian capital markets is something that's very relevant for all the knowledge-based sectors, and in particular, the life sciences sector. And that is a bit of a shift away from our traditional strengths in Canada. Canada is no longer just about mining, we're just about energy. To be clear, that's still hugely important to the Canadian capital markets, but what we've seen is this shift over the last number of years. This pie chart that you see on the screen shows the makeup of the value of issuers listed on TSX. And what will stand out is that mining companies now only represent about 10% of the value, and energy companies represent only about 15%. So collectively, the two things that Canada is known for are actually no longer the biggest by any stretch. What's happened is that there's been a big shift as a result of commodity price changes and so on, a big shift of capital away from those two buckets and into the all-encompassing bucket called other. Which includes, of course, life sciences, but includes a lot of the other sectors. And so the Canadian economy and the Canadian capital markets have become much more diversified. I think what's important is to see that sort of in a different light, which is specifically how that's manifests itself in growth. And so we've got two different charts that look at this. The first chart you see here is very simply a look at the fastest growing sectors on TSX in 2013. Very simply, this looks at the aggregate value of the sector at the beginning of the year and the aggregate value of the sector at the end of the year. And you can see that by far the fastest growing sectors are what we characterize as the innovation sectors, which are clean tech, technology, and life sciences, broadly the knowledge-based sectors. What's interesting, first of all, is how fast they've been growing. What's also interesting is where you see mining and energy right at the bottom of the list as being the big retreaters in terms of growth. That's, again, reflecting the sort of shift in investor sentiment currently. The second point to show is where the going public transactions have been in the last year, and it's the same sort of trend, where you've seen innovation companies starting to rise to the top in terms of the sheer number of going public transactions. So taking that down specifically to life sciences, let me just sort of show you the growth or trend that we saw again in the last 12 months in that space. At the beginning of 2013, it was a $7 billion sector. This is not big. And to be clear, I've excluded from this the one massive company that we have in Canada, being Valiant. They are a $20, $30 billion company, actually more now, and they obviously skew the numbers. So I've pulled them out of all this analysis, and so what you're left with is sort of the core, smaller, earlier stage companies. So it began the year at $7 billion. At the end of the year, it had grown by 55% to $11 billion. That's pretty impressive. It's still small, but it's an impressive move, and the drivers of that were a combination of share price appreciation, additional capital being raised, and then some going public activity. So I think an important positive trend we've seen driving the sector. Last couple charts I want to show you are around the capital or access to capital that life sciences companies have seen. And again, I've excluded Valiant from this. They were able to raise $2.5 billion last year alone, and so that would obviously skew the numbers. But what you see out of this is actually really interesting. First of all, for 5 consecutive years, between $400 and $500 million was raised each year by life sciences companies. Pretty good. Not a massive number again, but pretty good in the context of companies having difficulty accessing capital generally in this sector. Second interesting thing to point out, though, is the number actually hasn't dramatically grown or frankly changed, despite everything I've said in the last 3 or 4 minutes about the shift in sentiment towards the innovation space. So that either is a problem or means there might be good things coming. And that's a matter of opinion, and I guess time will tell. 3 key things to take away from this chart, though. First of all, deal sizes. They're really small. Companies that raise capital publicly in the life sciences space are doing very small deals. 60% of the deals are actually happening on our junior exchange, which is called TSX Venture Exchange. And you can see the average deal size is about 5 million. The median, if you prefer to look at that, is only 1 million. So it's really, really small financings. Second thing of note, the structure that is most commonly used is private placement work. Lots of private placements are being done. Over 80% of the deals are affected that way. And thirdly, and I think this is actually most interesting, even though it's very small, even though the total numbers are small, the breadth is quite big. 130 different companies raised money over this 5-year period. And over 70% of them, so about 100 of those, were able to access the capital markets on multiple occasions during that 5-year period. So it's a lot of companies who are getting access, but they're small. Last chart to show you is just a listing of the going public transactions we've seen since the beginning of 2013. And there's really 3 things, again, to draw from that. First, 9 of the 10 deals are happening on TSX Venture, so repeating the theme that this is a small cap exchange. Secondly, 8 of the 10 deals have been done via a structure that's called a QT or an RTO. We're going to talk more about that later. Just suffice it to say, for now, it's a structure that's has some advantages for smaller cap companies. And lastly, small deals. So you've heard the message repeated now a few times. Small deals, but lots of different companies getting access. With that, I'll leave it because I know we're going to have lots of further time for discussion on this.
Thank you, Michael. Obviously, Michael's providing a snapshot of what is happening at the public company level. So let's go down the panel and get a perspective. Generally, in the market might include public companies, but also for the private companies. Maybe I'll start with you, Dave.
I suppose that the principal purpose of today's meeting is to help inform members of LSO or visitors to LSO how to access capital. Otherwise, why would you be here? And without wishing to be a spoiler, I think it's also important to send the message about what's wrong with the access to capital issue in Canada for life sciences companies, because every member of this organization and of our industry should be beating down the doors of those politicians who are mandated to foster and promote capital formation for the life sciences in Canada. So without beating too long on it, heavily yes, but not long, the principal impediment to life science access to capital in this country, in the public markets, actually even in the private markets, is the disincentives that Canadian tax policy has specifically for life sciences companies. And that disincentive is the fact that if you are a clean tech company, or if you are in the business of geological exploration, flow-through shares provide a subsidy to investors of 50% of the amount of money that an investor puts into an investment. A life sciences company with a higher risk profile than doing biological exploration, if you will, a higher risk profile than geological exploration, is not permitted to access capital through the flow-through system, and consequently, any investor presented with two opportunities of equal risk, one in geology and one in biology, would need a brain transplant to actually buy the biological exploration financing. And consequently, this room is required to make this critically important to our own future, and keep banging on this door, because unless and until that changes, we have this huge impediment to capital. The second issue is Michael's data and mine differ. I do not see a single IPO in Canada in the life sciences in the last 5 years greater than $2.9 million, of which there was one in 2013. So in 5 years, not an IPO in this country. And in the United States, 2013 was the biggest year ever for IPOs, with something around $3 billion raised. Financing in Canada for existing life sciences companies, my data show $355 million, ex-Valiant of course, and in the US, $8 billion. So the response to the issue, where is the capital? The answer is, it's in the United States. And for the rest of the morning, you will hear everything that I might be able to add is get on your horse, get down to the United States, because that's where the money is. List your shares in the United States, because that's what the US companies want, and be public. I know we're going to get to the question of public versus private, but I'm a huge fan of being public. The principle being, you might not like the price of your next issue, but at least when you're public, there is money at some price.
Thank you, David. I did tell you we were going to hear all perspectives today. And Natalie, if you want to give us yours.
I'm going to give a bit of a broader perspective in the sense of the capital markets as well. And I see the activity in the US as a positive in the sense that it generates positive investor comfort around what's happening in the biotech industry. I know that we haven't seen the same levels in Canada, and I also think that the amount of money, the sources of funding that came through were from different sources. So we've seen less coming from VC capital, but more from angels, and also corporate venture deals that are becoming a little more popular down the road. The positive that's coming from the markets in the US will continue, I believe, if the companies can continue to execute on their R&D, as well as their market strategies. So if they can continue to generate some positive sentiment there, that will certainly help. And in Canada, we've seen quite a bit in M&A, as well as some exits recently, and I think that will continue to generate some more positive feedback in the economy.
Thank you, Natalie. Ivan?
Okay, so I'm basically going to say the same thing as David, but from the private equity perspective. So, you know, the situation is that, you know, from the perspective of an early stage therapeutic company, there's really 5 VC firms in Canada that you can approach, and that's been the case for some time and hasn't changed. And at least in our situation, we don't have the time to wait for that to change. So, and really, quite honestly, none of them are truly early stage, maybe with 1 or 2 exceptions. And so that leads you very quickly to the alternative, you know, which is going south of the border, where, at least from our experience, we seem to have far more traction. There seems to be a lot of depth in the VC community, And there seems to be a really positive sentiment that's happening, I guess, a trickle-down effect from the IPO situation. But we feel that it's really just all happening in the States. So that's really my take on private equity financing here in Canada.
Thank you.
Thank you. My perspective is more from the public markets, being from a boutique investment bank. The way we see the current environment is that, yes, there's a recognition that the love affair with the resource sector is temporarily in hibernation, but I would caution that that's likely to be a short-term phenomenon. These things generally don't last for more than a few years. That being said, that does give life science companies a bit more of a window of opportunity to be able to garner the attention of investors with less competition. So there is a shift that's happening. I think there are more and more public investors in institutions and small funds that want life science exposure. I think roughly 3.6% weighting on the S&P TSX is healthcare, and there have been a number of large companies that have either been bought out or privatized, and wealth has been created there. So investors are certainly looking to redeploy that capital to additional life science stories. I think there's a shift towards a greater understanding of the value proposition around life sciences companies. Perhaps not at an extremely early stage, but I think once companies get at least into the clinic, more and more institutions, even generalists, are now understanding the process of drug development a little bit more than it was maybe 10 years ago. But generally they still prefer lower risk, revenue generating stories, or clear milestones to show that companies are being able to generate revenue within a reasonable time frame. In the US, there's a lot more healthcare specialist funds, and that's something we don't see here in Canada at all. There's very few, if any, healthcare specialist funds. We're starting to see a shift because more and more institutions are actually hiring specific analysts that are trained in biotechnology, trained in the analysis of these companies. So we see that as a very positive sign. But by and large, if you have complex science and you're in early stage, as most of the panel has already said, capital in the US is far more, I guess, intelligent in that way, and they'll be more receptive to those stories. What I see as a lagging indicator is investment banking. Generally, investment banks tend to hire bankers and hire analysts 6 months into a cycle, so we're always a little bit behind the curve, so I'll take that as a positive trend in the public markets.
That's interesting. Thank you all.
Can I make a comment on
Sure.
Prakash's? Prakash correctly points out that most of the interest in public markets is in clinical stage companies. And the reason for that, of course, is that things happen. There's data, and there's good and bad, and so investors have the opportunity of seeing volatility in the stock. I'd point out that Stem Cell Therapeutics just 2 months ago raised $33 million on a $12 million market cap, so $33 million new dollars. And the asset at Stem Cell Therapeutics is 2 years away from the clinic and 3 years away from data. So U.S. investors have the ability, not always the appetite, but the ability to do what we don't have the ability to do in public markets in Canada.
That kind of leads us into our second question, which is perhaps this is for Prakash and David. You could give us a little bit of insight on what types of deals are being done. There are some being done. What are the types of deal terms you're seeing in Canada?
Prakash is
Should I
yours.
start? Yeah, sure. Again, perspective on the public side. Generally speaking, for smaller companies, investors are more attracted to deal structures that help mitigate risk, and one of the most common sources of mitigating risk are unit deals, where companies will offer units comprised of a share plus either half or a full warrant, and that certainly allows them to participate at a discount to valuation, but also have some significant upside if the company does really well. And these sweeteners for financings are generally done where there's a lot of risk involved, where it's difficult to complete the transaction with a given set of investors. And it also helps to bring in investors that are non-healthcare specialists, and that's what we're starting to see a lot more. Common shares are still done at a discount to market, but I would have to say that They tend to be done more with well-established companies that have been performing well. There are exceptions to it, of course, but that I think would be a general rule. What we're starting to see a little bit more is the area of convertible debentures as well as subscription receipts. And the subscription receipts are essentially mechanisms to allow companies who, investors who don't want to invest in private companies, the opportunity to invest in those companies with the caveat that they will go public within a defined period of time. So it allows them to invest in those early stage companies, knowing that they'll go knowing that they'll go from private to public, but also not necessarily trip on any internal controls or regulatory issues they have within their funds. So that those are some of the key things that we're seeing on the deal structure side.
And back on the public markets issue, the attraction of being public, even if you're small and the shares have an absence of great liquidity, is the private placement in a public company, otherwise known as a PIPE. At YM Biosciences, through Brian Bloom, who subsequently created Bloom Burton, we did a $15 million PIPE on a $15 million market cap. And that was, of course, many years ago. And the PIPE market is one that is only, of course, available to you if you are public. So you're going to hear this morning about why it's dangerous to be public, particularly if you're small and it's too early stage. But again, I urge you, don't lose sight of that.
Thank you. I read an interesting statistic the other day that while small and medium enterprises rely heavily on personal finances to fund early stage growth, credit from banks and other financial institutions are the next most relied on source of funds for businesses at the startup stage. I'm going to turn the mic over now to Natalie, who's going to come up and speak a little bit about how the World Bank can help young companies access capital.
Thank you, Tracy. Good morning. So today I'm going to talk about the role that banks play in the life science economy. And I'm going to take a step back to give some context around the different capital structures at different stages of commercialization. Okay, so where does all the magic start? Well, it starts with the entrepreneur. They put our savings to use in the market. And I took some classic figures from biotech, but Boyan Swanson with Genentech and George Ratman from Amgen. Not only did they give great benefits to patients, they're also great drivers of the economy. So they're very important to the health of our industries, basically. And the business of biotechnologies cover a wide spectrum, and it starts from the basic research all the way to commercialization. And biotechnology will start normally with IP that's developed from a lab, and then at every step there is value added. At each step during the commercialization process, there are different risk levels and different sources of capital that match those needs. So early on, as these companies are doing more of the research, the marketing and the operations, you're looking more at an equity source to make sure that they can get to those commercialization milestones. And what helps to drive the raise in equity is really the valuations that these companies can get. The reason why there is a difference between equity and debt goes back to the relationship between risk and reward. So for equity investors, you're looking more at a higher risk, longer term to repayment, but the reward is often greater than what you would get if you were in debt. So banks tend to play more in the lower risk, lower reward bucket of the equation. So banks will look at lower risk, lower rewards. It's also safer and cheaper for the company. Obviously a lot harder to get. You need to get to certain commercialization milestones before you can access that senior debt capital. Banks will look at taking the senior debt risk versus the equity risk. And in order to do that, the companies need to have sustainable cash flow to support those borrowings. companies will use different types of capital structures, and today it's a very high-level description of what these structures are. A lot of companies that start off with debt structures will look at perhaps doing a shred loan, which is short-term and is based basically on your shred claims. As they keep growing and commercializing, their working capital needs becomes the next most important things. And that's really just making sure that there's enough to continue growing. That's based usually on your account receivables. And then finally, as it keeps getting bigger too, the companies can look at doing more of term loans, which are longer, a little riskier, and need a good track record of cash flow to support it. I know a lot of people look to us for senior debt, but we do offer a lot more than that, and we're really the advisors to a lot of our clients. So we look at a number of things, including strategic partnerships, making sure that we share our networks of industry specialists with our clients, and it could be investors as well.